You watch him step out of a car that costs more than most people's houses, and the first thing you get wrong is assuming he paid for it. He didn't. Almost none of what you're about to see was paid for the way you think of paying for things. Cash out, item in hand, done. That's not how this works at the top. Up here, spending money is considered a rookie mistake. The real game is using other people's money, other people's structures, and other people's tax code to acquire things while your own capital never leaves the machine that's compounding it. The car. He drives a car that retails for $220,000. He doesn't own it personally. His business does. The lease payment is $4,200 a month, and because the vehicle is used for business purposes, it's a deductible expense. He's not paying for a car. He's reducing his taxable income while driving it. At the end of the lease, he doesn't buy it out. He rolls into the next one. The car was never an asset to him. It was never meant to be. It's a line item that happens to have leather seats. The house. The house is worth $4.3 million. He didn't write a check for it either. He took out a mortgage at a rate lower than what his investment portfolio returns in an average year, and he kept his own cash invested instead of tying it up in a house that doesn't pay him anything back. This is the part almost nobody understands. Rich people don't avoid debt. They avoid bad debt. A mortgage on an appreciating asset held at a low fixed rate, while your capital works harder somewhere else, isn't debt in the way you were taught to fear it. It's arbitrage. The bank is functionally financing his lifestyle while his money multiplies somewhere else, untouched. The watch. The watch on his wrist is a steel sports model that's nearly impossible to buy at retail, and it's already worth more than what he paid for it 18 months ago. He knows this because he checked before he put it on this morning. Certain luxury watches don't depreciate the way normal purchases do. They appreciate, sometimes faster than stocks. He's not wearing a watch, he's wearing collateral. If he needed liquidity tomorrow, he could borrow against that watch, or against his art collection, or against a wine cellar he's never once opened a bottle from purely for enjoyment. Physical assets that appreciate can be pledged as collateral for loans, and loans are not taxable income. He can access the value of what he owns without ever selling it, without ever triggering a capital gains tax, without ever technically spending a dollar of his own. The jet. He doesn't own a plane. Owning a plane is what people do when they want to lose money quickly and tell everyone about it. He belongs to a fractional ownership program instead, paying for a share of flight hours through a company that owns and maintains the aircraft. And because the flights are logged for client meetings, property inspections, and board commitments, the cost becomes a business expense. He flew to 4 cities last month. On paper, none of those trips cost him anything personally. They reduced what he owed the government. The boat. There's a boat docked at a marina 3 states away that he uses roughly 6 weekends a year. He didn't buy it outright either. It's held inside a chartering LLC, and when he's not using it, the boat is rented out to other people through a management company that handles the bookings. The charter income offsets a meaningful portion of the carrying costs, the depreciation on the vessel becomes a deductible business loss, and the 6 weekends he actually spends on it are categorized, correctly, as owner usage of a business asset. The boat pays for a piece of itself. He just enjoys the piece that's left over. The art. There's a painting in his office that costs $600,000. He didn't buy it to look at it, although he does enjoy looking at it. He bought it because fine art can be used as collateral through specialized art lending firms, the same way real estate or securities can. He borrowed against it within a year of purchasing it, using the loan to fund a stake in a private company he believed in. The painting still hangs exactly where it always has. He never sold it. He never will, unless the tax structure changes and selling suddenly makes more sense than holding. The painting isn't decoration. It's a vault with a frame around it. The membership. There's a club he belongs to that doesn't advertise, doesn't have a sign, and costs $250,000 to join before a single monthly fee. He didn't pay the initiation fee personally either. The membership sits inside a corporate entity, categorized as a client entertainment expense, because deals genuinely do get discussed on that golf course, in that dining room, in that private lounge overlooking a city he doesn't live in. The line between networking and leisure is once again a matter of documentation, and documentation is something he pays other people to be extremely good at. The wine. The cellar underneath the house holds bottles worth more than most cars. He bought most of them at auction, not to drink, but because certain vintages appreciate in a way that outpaces inflation reliably enough that collectors treat wine as its own asset class. He insures the collection. He tracks its value the way he tracks a stock portfolio. Every few years he sells a portion of it at a gain, and because it's classified as a collectible rather than income, it's taxed differently than a paycheck ever would be. The bottles he actually drinks are the cheap ones, bought separately, with cash. because those don't need to perform any function beyond being enjoyed on a Tuesday night. The vacations. The trip to Italy last spring was booked through his holding company as a site visit for a property acquisition that was, in fact, real. He spent 4 days evaluating a vineyard investment and 3 days doing things that had nothing to do with vineyards. The 4 days were deductible. The rest was just life, folded into a trip that was already paying for itself. This is not fraud, this is documentation. The line between a business trip and a vacation is drawn entirely by paperwork, and he has people whose only job is drawing that line correctly. The insurance policy nobody mentions. There's one more piece almost nobody outside of private banking ever hears about. He holds a permanent life insurance policy with a cash value component, funded aggressively in his 30s. That cash value grows tax-deferred, and once it's large enough, he can borrow against it at a low interest rate, using the loan for anything he wants, a new deal, a renovation, a slow month, without ever surrendering the policy or triggering a taxable event. He will likely never fully repay these loans in his lifetime. When he dies, the death benefit pays off the outstanding balance automatically, and whatever remains passes to his family, still shielded from the taxes that would have applied if he'd simply sold assets to raise the same cash while he was alive. It is, quietly, one of the most efficient borrowing tools that exists, and it's almost entirely invisible to anyone who hasn't already crossed a certain threshold of net worth. The mechanism. None of this is a secret. None of it is illegal. It's simply unavailable to most people, not because of a law, but because of a lack of capital to begin with, and a lack of exposure to how the system is designed to be used. You need assets before you can borrow against assets. You need a business before you can route expenses through a business. You need enough net worth for a bank to compete for your loan instead of scrutinizing your application. The wealthy don't avoid spending money. They avoid spending their own money in a way that shrinks their asset base, when the entire system is built to let them spend borrowed money, business money, or someone else's money instead, while their own capital keeps compounding, untouched in the background. Every mechanism you've just watched shares the same underlying shape. An asset gets acquired. The asset appreciates or produces income. The asset gets pledged, not sold, as collateral. The loan proceeds fund the lifestyle. The original asset stays in place, still growing, still working, never triggering a tax event, because on paper, nothing was ever technically sold. This cycle has a name in private banking circles. Buy, borrow, die. It sounds almost cynical when you say it out loud, but it describes, with total accuracy, how an enormous share of visible wealth in this country is actually financed. The part that takes longest to sink in is that none of these individual pieces are the strategy. The car isn't the strategy. The painting isn't the strategy. Each one is just an application of the same handful of principles, repeated across every category of spending until an entire lifestyle has been rebuilt on top of borrowed liquidity and appreciating collateral instead of earned income. The people who live this way didn't invent anything new. They simply refused to accept that the only way to enjoy an asset is to eventually give it up. Now. Luxury at this level isn't about the thing, it's about the structure underneath the thing. The car, the house, the watch, the art, the jet, the boat, the cellar, the club, none of them are the point. They're just what leverage looks like when it's worn well, when it's aged in oak barrels, when it's parked in a garage that doesn't have his name on the deed either. Somewhere tonight, someone is sitting across from a private banker for the first time, nervous, holding a net worth statement they're not sure is impressive enough to be in the room. They think the meeting is about opening an account. It isn't. It's about being handed the door that was always there, just never unlocked for them until now.